Hey everyone, it is Jay Soloff from Investors Alley, and this is our options trade of the week. We're looking at Market Chameleon's unusual option volume, and you can see there's plenty of activity. It remains a very active period for options considering all the big moves in stocks and ETFs. You can see here you have oil and Russell 2000 small caps and high yield all here near the top. Let's look at the Russell 2000. And if we look at some of the trades, I'm sure you'll see a lot of big trades because it's a very popular index. So we'll sort it by quantity. All right, so looks like, so this one here, right off the bat, what's most likely going on here is a May put being rolled up. So we have IWM at 123.72, right? So there was probably a 110 put, and you can see there's a bunch of open interest there. So someone probably had a 110 put they were using as a hedge. Now that we're up to 123, they probably moved this put up to 120. You can see there is not as much open interest as volume here, 22,500. So someone's spending about $6 million or so, $6.2 million to roll this trade up as a hedge. So it could be part of a hedged small cap strategy. It could just be someone who a fund that has a lot of small caps just wanting to hedge their downside risk. So yeah, $6 is a lot to pay. 13.5 million on 22,000. If they weren't rolling it, that's how much they'd have to pay. But if you think about it, if you own a ton of stocks, millions of dollars worth of small cap stocks, then this is a small price to pay for a hedge. If it goes way down, this will protect all the way down to 114, and so a pretty significant drop. I think Russell got down to about 95 at the low. So this could, if we have a second leg down, this will definitely protect that position. So looking at that from and here you can see, we were talking about looking at the chart, 95 was the low, we're at 123. So this is basically protects, from this point on, about 114 downward, you have protection over the next, about 35 days or so. Let's look at that trade here. So if you're looking at May 15th, you could see here that 110 put, so it was rolled up to the 120. So that's an easy trade if you just wanted to buy the put. However, if you wanted to save some money, you could do this as like a put spread. So let's say you wanted to buy the 120 put, but you wanted to not spend as much money. Well, you could do maybe like the 120, 115. It'll only cost you $1.59, but will protect you down to 115. So you'd make about $3.50 on in profit if you were to drop, or you could do, let's say the 115. Let's say 105. So if you want to protect more, you'd only spend $2.28, but you can make about over $7.50 if it were to drop down. So different ways you could do this to save money. Buying a put outright is expensive, but again, if you have a lot of stocks, then it's a small price to pay to hedge your downside. In this market, that's not a bad thing to be looking at. And if you want to find more about these strategies and other subjects that I teach and talk about, you can check out the links on this page and check out some of my services.